Okay, well, good morning, everyone. I'm Mary Preenon. I'm the Director of Communications for the Hudson Gateway Association of Realtors, and welcome once again to another Breakfast with Benefits. Today, we are going to talk about a really important topic, which is credit, because everybody needs good credit to buy a house. And it is being presented brought to us by Prime Lending today. And I'm going to introduce to you John Reedy, and John is with Prime Lending. So good morning, John, and thank you.
Good morning, Mary. Good morning, everybody. Pleasure to be here and pleasure to sponsor this great event with Jeanne Kelly. And I think everybody will come away from this meeting learning a little bit more about the importance of credit and some of the things that you can do to enhance your credit, number one, and enhance your clients' credit so that they can become approvable. Jeanne and I have been working together for almost 20 years. I highly recommend her company and have been doing so for a long, long time. We have so many examples of people that either had issues with credit that needed to be resolved, or sometimes you get that occasional borrower who says, oh, I don't need anything. And then you run their credit report and they don't understand how their scores are 640. Well, it happens. And sometimes they don't understand why it happens. But we've had many examples of that where people didn't understand or realize what their actual credit score was. And it needed to be repaired. So I'm not going to spend a whole lot of time talking because I think Jeannie's going to bring to you a lot of things that will help and understand the process a little bit better and understand what we can do working with her as a part of Prime Lending. If you don't know Prime Lending, we are a mortgage company out of Dallas, Texas. I have been in the market for 20 years with Wells Fargo, TG, Federal Credit Union, and now Prime Lending. I've worked all markets in New York, and I am always available to help anybody in any way, their clients, to get a mortgage. So with that said, I'm going to let Jeanne take it away.
Oh, thanks, John. And hi, everyone. Let me bring up the PowerPoint. Let's see if I can share my screen. And here we go. Let's see. Sharing screen. New share? No. Hold on. Basic. And this is how we flow. Okay. Is this coming up? Are you seeing the whole screen? Okay, there we go.
There we go.
Thank you. And I'm really excited, by the way. When it comes to credit, a lot of times people don't think how important it is in the real estate world. I don't understand it. And I'm really happy that this year, I don't know if any of you know, Success Magazine happens to be a favorite of mine. And they even I'm nominated and won only 25 individuals, their Real Estate Trendsetter Award. So even though I'm not a realtor and I do not sell homes or write mortgages, I found it very important that for real estate, they do see how important your credit score is. So I am, very honored that I received that award. And I just want to say that when it comes to, it's not anymore decline or approved. It's really what can you get the most when it comes to having a healthier credit? How much house can you afford more? How much, and John, you can probably teach us, when your score is higher, you can put down possibly less. Instead of 20%, there'd be something better, 10% or even lower than that, right? John, when it comes to your credit score and where the levels are, you can talk about that part.
I mean, credit is, paramount for the whole process. And, a lot of times people will call and say, what's your interest rate? Well, your interest rate is predicated on what your scores are, and it has an effect on a variety of different things. It will affect what your homeowner's insurance is going to be. If you're not putting 20% down, it will definitely affect your PMI insurance. So there's a variety of things that the more optimum you can get the score, the more options you can provide to the customer. Particularly in areas where, somebody might qualify for FHA, for example, but if they can improve their score slightly or a little bit better score, they'll be out of that and into a conventional mortgage situation as well. So options are key, but the key to the whole option game is to have a good credit score.
Yeah. And I wanted to review some credit myths, because how many of you hear from your clients, like, I know what my credit score is, because they go on a site and let's say it's Credit Karma. And so Credit Karma to me in the credit world it might be how Zillow is to you in the real estate world, meaning I'm not saying it's not a tool that doesn't help. You can still, it's a marketing site, but that score is not the score lenders use. 90% of lenders use the FICO score. So Credit Karma is not the same score. And there's not just one score out there. There's obviously many scores, but being realtors, you really want to pay attention to the FICO score. And another myth is, I don't want to look at my credit. If I pull my credit report, it's going to hurt my score. But when your customers are pulling their own credit, that's a healthy financial habit to have. No one, even having a monitoring service, which I believe in ID protection, but even having that, no one knows myself what belongs on my credit report, what my balances are, where did I live. So it's a good thing to get into reviewing your credit reports. Another myth that happens, I'll just close that account that has negative information and then it can come off my credit report. Obviously, everyone would just do that. If there's a negative item on your credit report, even if the account is closed, the negative history can stay on the credit report for up to 7 years. So those are some of the myths that have, and also a lot of times people, they think they had bad credit. Let's say they had a hard time and there was a bankruptcy or a foreclosure. Then they just think they always have bad credit. And there is a way to rebuild healthy credit. And that's what I'm here to help with. I wanted to put up, and actually, John, this is an example of working with one of your clients. So I'm so glad you're here today, because this is an actual example of a client that was looking, it's the same house. This person, it was the same exact house. It was a 565 purchase. The only difference is the score went from a 665 to 747. And with that change in the score, it totally changed the price of that house over 30 years. It changed, like John was talking about, the PMI every single month, how much that changed. It changed also the down payment. So what does that mean for a realtor? That means a client can afford a much higher price of the house if they have a higher score. And that's what's really important. John, did you want to talk about anything regarding this client?
Yeah, this is such a prime example, and no pun intended. This is a great example, if you will, of a situation in which you get a borrower that comes to you and their score is low, and this is the result of what that score is going to mean to them. Now, I have been doing this for 20 some odd years, and it's amazing to me how many times I'll get a call from one of my referral partners and said, hey, we just tried to go to such and such a bank and they said the credit score is this and they can only run FHA. Wait a minute. What did anybody do to try to help this customer achieve a better score? What did they try to do? Did they just say, sorry, can't do it? Because it's so many times I have had these questions, can you look at this? And I'm thinking, I've been doing this 20 years. If I see something like this at 665, I'm going to look at that credit score in detail I'm going to look at what things can be done. Now, there's two ways of doing this. One is if you have credit scores that are affected by your credit balances, for example, you could pay down those and get a rapid rescore of your credit, and your scores will go up. Now, that's the easy version. The harder version is when you have all kinds of derogatories on your credit, and you look at it and you say, how do I get this fixed? That's when an expert such as Jeanne would come in and say, okay, we have to call this company, we have to do this. I mean, I've known Jeanne to call the courts to try to find a way to have something in the court system that is being reported taken off. So there's a lot of work involved in just getting your credit improved. And that's why there's so many things that can be done. But when I see an example like this is such a great example, because this person was looking at such a different scenario before the credit was improved. So this is a great scenario right here and a great story.
Thanks. Yeah. And one thing I want to mention right away is annualcreditreport.com. When you hear the name annual, you think once a year, but you can go to annualcreditreport.com and obtain your credit report for free, not hurt your score. This is to look at your reports. It's sponsored by all three credit reporting agencies. And the good thing is that until 2024, unless they change it again, but because of the pandemic, they have you that you can obtain your credit report every 7 days for free. So a lot of times people will say, well, why do I have to look at it that much? Well, during the home processing, you want to look at your credit report every 7 days. You want to make sure your balances are where they should be. If you're working with like John and John's saying lower these balances, everything isn't instant like we think, right? Oh, I see my balance with, let's just say, Citibank lowered on my portal. That doesn't mean that the Experian has that information, let's say. So you want to look and look at your credit report and see when those balances are updated. And this is a guessing game, and then your lender can pull a report. So again, it's free, doesn't hurt your credit score, healthy habit to get into. And I want to say that with working with others regarding credit for over 20 years, I've never looked at a credit report without an issue. So if you haven't looked at your credit report in a while, I suggest you do today, because sure, there's a mistake on the credit report. And now I just want to break down the FICO score.
Hey,
Because,
Jeanne,
yeah,
can I add one thing?
yeah, go.
That's a great point, because when we run credit, a lot of times, I'll share the credit report and share the information with the customer. And there's been times when the customer will, call me up and say, hey, wait a minute, this is not right. This is absolutely not right. This is not my score. I don't know what they're talking about, blah, blah, blah. Now, the question is, how do the scores get translated? And it's the creditor who reports the scores to the bureaus. The bureaus don't go out and seek information. The creditor sends information into the credit bureaus, and that's how the scores are generated. So when somebody gets very upset that their scores are, there's some mistake on their credit report, it's not the credit bureaus that is doing that. It's the creditor you have to get to say, you're reporting this information incorrectly. And that's a big thing. And it's one of the things that Jeanne does to help people as well. Because sometimes, let's face it, they don't report the information correctly. So.
Right. Yeah, all the time. So we have to, the breakdown of the FICO score, because again, that's what we want to pay attention to. Because when it comes to real estate and your clients purchase a home, that's the score that matters. And a lot of people don't know what makes it up. And it's 5 parts, very simple. payment history being the biggest score. So if you have late payments, collections, that's all going to take down this part of the score. When it comes to public records, back before 2017, you would see tax liens and judgments on your credit report. After 2017, rolling 18, only bankruptcies are on Experian, TransUnion, and Equifax. Not other reports out there, obviously, for purchasing home, but it's not part of your FICO score anymore. Only will be on your credit report, and that is the only public see on credit reports. So that's very important to know that there are other companies out there, that would pull that information, but it's not part of your FICO anymore. And a big part of this, and I really want to talk about something new that you can share with your clients and your referral base. When it comes to collection accounts, there's been a major change with credit reporting, and this happened in April. So that's not that long ago. In April, Experian, Equifax, and TransUnion decided to remove all medical collections that had balances under $500. So all medical collections under $500 are no longer reporting on your credit reports. So you could have worked with someone 6 months ago that had a lot of medical co-pays and things like that, and their score was hurt. If they relook at their credit now, all of those accounts under $500 are no longer reporting when it comes to medical collections. So that's a big change. And when that happened, 70% of medical collections were removed from all the credit reports. Now, what's left? Anything over, right? So maybe there is $1,000 medical bill or 600 or 501, whatever it may be. Here's the next good part when it comes to medical collections. The change happens that once a medical collection is updated as paid, it is removed. So if you have a client that has $600 medical collection, as soon as it's updated as paid, it triggers an automatic removal. So that is part of your score. So right now, as of today, if there's a client that has a $600 medical collection, it's a collection on their credit report. It's affecting their FICO score 100. But once it's removed and it's no longer there, the score can improve. So just know that those major changes have just recently happened as of April. So we can look at credit reports, we can see medical debt over $500 and know there is a solution. And that's good news when it comes to the medical collections. Any other collection, such as, let's just say Verizon, if that gets updated as paid, your score actually drops when a collection is updated. So that's why we have to really pay attention to what's going to help the score. A lot of times people think, well, if I pay a collection and it gets updated as paid, that's going to help my FICO score. It doesn't help it in the moment. So it's very important to know that information. But when it comes to medical changes, that's huge. And also when it comes to late payments, in the moment is a big deal. Time heals all wounds, and same with your credit report. So if you have had a client that just always had 800 scores, and unfortunately she had a problem with J.Crew in April and May of 2023. Her score went down to 710. But she was purchasing a jumbo, mortgage. She needed 710. It was a serious problem when she was pre-approved with an 800. And obviously we worked together. There was a reason for that with working with us. We moved that. Her score went right back up. So again, it was because it was a recent late, not something from 5 years ago, even though that can still affect your score. It's the more recent, the more it's going to hurt your score. And then John mentioned earlier, the amount you owe. So 30% of the score. And a lot of times when I say 30% of your score, people think that means bring your credit card balances down to 30%. I don't know how many of you have heard that, but it's 30% of your score. The lower the balance is, the better. So not 30%. It's good to bring them down. Let's get them down to 10% to your limit, if possible. And if you do that, it's a big part of your score. That can change your score. That can have someone go from, let's say they're needing a 720. They could be at a 710, 700, lower the balance, the score can go up. And that's for revolving. Now, I'm not going to say that installment loans aren't included in this part of the score, but we know mortgages, student loans, those are large items. You can pay off $100,000 student loan and get only 1 point. So I have to put it in there. It's part of the algorithm, but it's not to pay attention to. You really, this part of the score, it's all about revolving, which means credit cards, lines of credits. And so the more that you can control, keeping those down, the better. And then 15% of the score is length. How long have you been using your credit? The longer, the better. You know, the longer you can have accounts on your credit report, it's going to be good. So that's why it's also important for us to teach our kids about healthy credit and using credit the right way, because you want them, your kids, to have good scores. So for me, when Cassandra, my daughter, was going into college, I made sure we opened up accounts for her, because by the time she graduated, that meant 4 years of history. And guess
That
what?
poor kid.
No, but you know what? After 4 years, when it came time, John, for her getting an apartment, I didn't need to go sign.
Exactly.
She had a great credit score, and not for nothing, John Reedy did. My daughter purchased a house in 2000, 22, 21, and John
21.
Reedy. Yep, John Reedy was able to close her. And of course, she had 800 scores. But this is because, again, length, even though they're young, we want to start explaining using credit at a young age, meaning, 18, begin teaching them about credit. And the longer we have it, the better. And then,
Hey,
yep, go
just-
ahead, John.
Just jump in for 1 second. A lot of times when you see that a person needs to pay down their credit cards, one of the pushbacks is always, well, I only have so much money to do down payment and closing. I can't afford to pay these down. Now, many, many times what we'll do is we'll look at the cost of paying them down, and the result of what the scores will be will give them much better options so that they can be able to do the mortgage and with the amount of money that they have. The myth is, oh, if I take money away to pay my credit cards down, I'm not going to have enough to close. Not true. In fact, you may have more, and you may have more options that way than you ever thought you did. So one of the things that is very, very important is to be able to look at that credit report, understand it, understand what you're trying to tell the customers to do, and to make sure that it's going to work. Because I just wanted to say one other thing here. I know that all of you, every realtor there, has a mortgage person of some kind that you do business with. You trust that they are going to do the very best job they can. And one of the things that we've been trying to do over time is to make sure that when we see a situation in which somebody's credit is impaired, they have to have the belief, they have to have the absolute assurity that what we're telling them is going to work. And it works every single time, whether it's just paying down cards or having Jeanne get involved in things that need ultimately a credit expert to fix, because there are, all kinds of different scenarios. Sometimes, credit, you can look at it, it's not just the scores. Sometimes they don't have enough scores. They don't have enough credit. So just something to throw out there.
Yeah. Yeah, it's putting the pieces together when it comes to credit. Just, in all of of our industries, right? You're a realtor, you understand when it comes to your client, location, school district, neighborhood, taxes. You know, when it comes to, on my desk, I live and breathe the credit reports. I love looking at a report and seeing a score and seeing how can I help this client have credit save them money, not cost them. And that's what's really important. And
Absolutely.
yeah, and another part, this is the love-hate relationship I have with the credit score, new credit, because a new inquiry and a new account before going for purchasing that home, that can hurt someone's credit score. And it's just the rules of the game. So anytime a new inquiry and account hits the credit report, it's going to drop the score, but then in time, 6 months, 8 months later, it helps the score. So this is why, unless we're building credit because someone has no credit, it's important that your clients know while they're house shopping, maybe they even found the house or in the mortgage process, don't be going to the furniture stores or appliance stores and getting a new account to save at that cash register, because it can totally change their approval process when it comes to a mortgage. So no, you know, no new credit before purchasing a home. And then the last part of the score is types of credit. The more you can have different types, meaning installments and credit cards. And so that's why even building credit, a lot of times individuals will just stick with credit cards, which is still great. But if you mix it up and also get a loan, that can help give you this extra 10% of the score. And every point matters when we're purchasing a home. You know, that's a large commitment, one of the biggest major purchases we have. So you want to have the highest score you possibly can. So in building credit, I always say, just like there's secured credit cards, there's secured loans, like a loan to yourself. Back in the day, you know, I used to have this, it was like called the holiday club, and you go to the bank and you put money in, and then in November they gave you all that money with interest, and it was just that it was your money and you were just saving it to help you with shopping. Well, that's how I feel like these loans are. When it's called, like, Self Loan is one company, there's others out there, but this one is called Self Loan. And they take the money, let's say you want to put away $100 a month, but they will put it on as an installment loan. So you may say, I want to take 12 months. So for 12 months, you pay $100 a month. They will report that on time payments, obviously, if you're building credit and you want the mix besides secured. And then after the 12 months, you get the money back with interest. And the great thing is, it was on your credit report. You might want to have one that's 24 months, you know, whatever it may be, to show longer on time payments. And again, 10%. Is it as much as those major 35% payment history and 30% balances? No, but I can see that every point matters. So that's what makes up the FICO score. And that's my presentation. I don't know if anyone has any questions regarding the changes or anything else, but please ask. Oh, there's things in the chat. I can't see them though, for some reason. John, can you see them?
Oh, I can see them.
Oh, okay.
We have, well, the first question is, people were wondering whether you would be able to share your PowerPoint presentation.
Oh, sure. I'll send it to you.
Okay, great. Athena had a question. Why does paying a delinquent non-medical account lower your score, and for how long?
Yeah. So it's one of those things. It's the algorithm of FICO. So what happens is, when it comes to collection out, it comes like an open date, and then it just kind of stays on your credit report. And the next time it gets updated is when it gets paid. So it brings almost a collection that could be on your credit report for 3 years. So like I said, time heals all wounds. So that collection, even though it's still negative on your credit report, let's say it's 3 years old. As soon as it gets updated to paid, that triggers a new date, and it almost makes the collection look like it's brand new. So it's just the way of the system. And, that's what the problem is. Now, if we can get it removed with a payment, that's a beautiful thing. And, that's something that we work on here at the Kelly Group. If possible, we try to find out, did they do everything right? Was there a dispute? Did they notify the customer correctly? And that's why we try to resolve it in more of a positive way. But otherwise, if a client is working on their credit and they pay that collection, it will drop the score, unfortunately.
Okay. You had mentioned, someone asked, what was the name of the company that you just mentioned?
Annualcreditreport.com. Oh, no, you mean for the loan. And if you go to my website, I have blogs and links to everything. But it's called Self Loan.
What about if a spouse's score is not as good and the other spouse is excellent? What happens in that case?
This is a great question, but more in line with the mortgage side than Jeannie. When a bank does a loan, they look at the lowest middle score of all the borrowers. So it doesn't matter who makes more money. It doesn't matter at all. It matters only if you're applying with someone else, and if it's your spouse and they have a lower middle score than you do, the loan will be calculated based upon the lower middle score. So oftentimes, I get people in fights all the time saying, hey, your score is excellent, but your spouse's score is not so good. And that's something that has to be corrected if you want to have both borrowers on the loan. Now, there's been times where that can happen, and you look at it, and one of the borrowers is really the breadwinner and making a lot of money and has the good credit score. And a lot of times the other one may not, and we're using their score, but it's lower. So we have to make a decision. Do we want to keep them on the loan or just add them to the deed and title and keep them off the mortgage? And that's some of the things you have to look at when that particular situation happens. And it happens quite a bit, unfortunately, that one spouse's score is better than the other, but it's always, remember, the middle score of the lowest middle score of all borrowers.
Right.
So Donna is asking, does paying with cryptocurrency affect your credit?
It's not. If it's not on your credit report, major creditors, if it's not something being reported, then it has nothing to do with your score.
Right.
Does it hurt your score to pay off most of your debt? For example, how does it affect your score if you only have 1 to 2 credit accounts open? It appears that as you pay off more debt, sometimes your score goes down from, let's say, like, an almost 800 to maybe a 750 or 40. It's as if you are penalized for paying off debt.
So that's a great question. And you know what? This just happened. One of my girlfriends called me saying, Jeannie, I've done, and we're going back 20 years. So she's like, I did everything, I always pay all my accounts on time. Now I'm to the stage that I paid off my mortgage. I buy cars cash. I only use one credit card. My score keeps dropping. So I looked at it and I said, you're disappearing. So when you paid off your mortgage, like, great, that's great. But at the same time, she stopped using all these credit cards. So she just, to organize things, she had one open active account, and which you need one open active account to even get a FICO score. So I'm not saying stay in debt, but at least keep those credit cards open to keep showing the length of history on accounts, that you can keep the balances low. When you start paying everything off, you can start seeing a drop in your score, not in the moment, by the way. And that's why she was confused, because she's like, I paid that off like 7 years ago. I'm like, right. And now it's, things are coming off your report. They are not showing that you had a mortgage. They're not showing that old BMW car, that you kept getting BMWs for the past 40 years. They're gone. So it is important when you are using your credit to keep using it. Like I said, credit is a beautiful thing. When we're using our credit cards, I use these as tools to maintain my 800 score, meaning I want to keep my balances low. I want to keep those old accounts open. Sometimes they're the store accounts. We want to hope they stay in business, right? Because I don't want them dropping off my credit report. And I want to pull those cards out of my wallet every once in a while and use them to show activity. And I want to get the rewards. I want to get the credit card rewards, with prices going up on things. If you look at your rewards, you might have a gas card that's going to be giving you money off at the pump. You might have credit cards that give you money off, cash back. Or if you like travel, you can get free airline. So I use credit for bills I already know I have to pay. I know I have to pay my Verizon, right? Or I know I have to pay gas in my car. I know I have to go get groceries. I know I have oil to put in my house. So I use credit cards for things I need to purchase anyway. And then I just pay them off with the credit cards. So I'm showing activity and I'm keeping those accounts open. But unfortunately, with your question, it is true. If you stop using credit, then we can't show a financial history on the credit report. So it can hurt your score.
Jeanne, I have a quick question. So in the spirit of what you just said, a lot of people love putting trips on their credit cards and you getting all those points. So I just had a client that ran up $40,000 on a trip and it really dinged credit. We
Right.
waited. We called the Amex. We said, when are you going to be reporting? They said, we're going to report this on this day. So we waited and they didn't report. So that's a problem because how long, is there anything to mitigate that to try to, other than waiting for it to report?
So here's the thing. Perfect example is that. I mean, yeah, it's great to be using that credit to maybe earn some of those rewards. But again, when we're purchasing homes, be careful of the reporting date. When it comes to your credit cards, it's just as important besides the minimum due date. You want to know your statement date, meaning the date you get that statement is the same date they're sending that information to the credit reporting agencies. So that means you want to know that date. Let's say it's the 10th of the month that you get your Amex or Chase or whoever it is. Every 10th of the month, I get that. When you're getting that information, that balance is the same balance going to the Experian, TransUnion, Equifax. Why don't you always know that date, pay your bill 72 hours before instead of after? I have a lot of clients who say, I pay it to zero when I get my statement. Well, guess what? They never see the zero because then you're using that account all month for your whatever you're doing. So if you learn the statement date, that's when you want to pay things before that. So if that client paid it before the statement date, when they kicked out the balance to the bureaus, it would have showed lower. Also, when it comes to American Express, they do have a division that will push a balance in 3 to 5 days. So it's just knowing that information. So if your client's still having an issue, let me know.
So pushing it back, meaning that's what they did. They called, they said they paid it off and then they said that they would report it, but they didn't report it. I waited a while before I ran the credit. It was still there. Like I waited 10 days and we just couldn't wait any longer. But
Okay.
Is there a workaround around that? Or is that just?
Well, every creditor has different policies, but I have to say American Express does have a division that will update if they know a mortgage is in the works. They will update it within 3 to 5 days, American Express. So maybe they just didn't get the right division to do that. And again, the other good thing is using that annualcreditreport.com, because then they could have seen it. You know what I mean? They could have went to that site and they could have said, okay, well, let me check. Did the balance get updated like they told me? And unfortunately, it sounds like they didn't for your client. But
We have quite a few more questions in the chat that I'd like to get to before our time runs out. There's quite a few about credit cards. One is asking about should you close the ones not being used?
no.
And is there a certain number of credit cards that are optimal, and should you hold debt on any of them?
Okay, great question. You don't want to close accounts. The only time I ever say, and I really, I'm very careful about this. The only time to close an account may be during a divorce if you're joint. And so you don't want financial responsibility with that individual anymore. But otherwise, you want to keep your accounts open. The longer they're open, the better for your credit. And not only that, I'll have clients who are, at a 738, needing 2 points. They don't have late payments. They don't have, their balances are beautiful. And I'll say, you know what? These 3 accounts, you haven't used them in a long time. They're on your credit report, but they're kind of hibernating. Pull them out of your wallet, buy something, and you'll get those points. And wouldn't you know, that's what happens. So you want to keep don't close credit card accounts, use them, mix them up. Don't let them actually, another thing that's happening right now, Mary, is that if creditors see that you're not using accounts, they'll close them. So you don't want that to happen. Mix them up. The other thing you said was, what did you say? The balances. Yes.
Yeah.
Leaving the balances. So here's the thing, and I see this all over TikTok and all that. They say that it doesn't matter if things show a 0 balance, you'll get points. I'm telling you, with the FICO algorithm for lenders' mortgages, 2, 4, and 5, FICO 2, 4, and 5, if you show a small balance, anything under 7% to the limit, it's not calculated in the score. So if you have a client, just for easy math, let's just say 10%. 10% to the limit, you'll get points. So yes, showing a small balance is helpful.
Someone is also asking about, can you get a mortgage if your employer pays you with cryptocurrency?
John.
That is something new. I saw that question earlier, and I'll tell you, I don't have the specific answer for that, but I was looking it up on the internet when I saw that question. And there are lenders who will utilize crypto. I will need to get back to you on that because I don't know the answer specifically enough to give you a concrete answer.
All right, this has been really, really interesting. And you know what, I just had a quick little story about myself. A few years back, I was purchasing a home, and everything, credit score was fine, everything went well. And then there was one, a late payment from years ago. It was like $20, and they were bringing that up, and they were holding up the mortgage. And I was like, are you out of your mind? 20, and I had to call the place, and they, had to get some guy from India on the phone and say, no, she wasn't late. It was, but it was just, to me, it was like, oh my God, are you kidding me? 20 days. Do you find that happening a lot?
Yeah, late payment, it doesn't matter if it's over. Listen, the one that I was talking about with J. Crew is over $1.62.
Oh,
$1.62.
Yeah.
So it doesn't matter the amount, it's that it wasn't paid. And there was a little issue there. And so it doesn't matter the amount, it's just, it is allowed. A negative item can stay on your credit report, the late payment, for up to 7 years, and it can be part of your score. So yeah, I know, I've heard it all.
Someone is also asking about when a creditor lowers credit amount because you don't use the card. Does that happen a lot?
So that's been happening, just like, so it can be lowered. They could all of a sudden notice even your score changing, and a creditor, even though you have always paid the account on time and everything's great, but maybe your score dipped for some reason, they can always, when you sign those applications, you're not reading maybe all the fine print, but they can look at your credit. And if they feel they want to lower the limit, they can. And again, then if they lower the limit, just think of that with the 10% again. Just change how much you're going to carry that balance. But and I'm definitely letting you all know, look at your credit reports, and there could be accounts on there you forgot about or you haven't used. Pull them out of your wallet. Make sure you're showing activity. Don't let them close, because I've been getting a lot of those phone calls. Lots of creditors are closing inactive accounts.
But isn't the opposite true though, too? If you're using a particular credit card, for example, I know I use my Marriott points credit card a lot, and they continue to want to give me more and more money all the time.
Yeah. Yes, exactly. Well, you're paying on time, you got a great score, and that's how they'll say, do you want more? Do you want more? Take the, I always say it's great. And maybe a lot of you have always had great credit. I don't know. I got in this industry because I had bad credit, and that's what got me into this after a divorce over 20 years ago. But when you need credit, and sometimes you're struggling to get it, right? So when you don't need credit, take it. That's when you take it, saying, hey, because I'm not at risk. And then if you need it, it's there. So, that's one thing I always say, get it when you don't need it. Unless if I knew, which now I purchased my house several years ago, this most recent one, I'm fine right now, but now I'm starting to think of another investment property. So now I won't be getting new credit until I purchase that investment property, but then it's playing the credit game. And there's changes, what I talk about today. If I talk to you in January, it's different than what I said today, because we had that new information regarding medical collections. That's huge news in the credit world, because it can really help your clients. You can have renters because maybe they had a lower score, and so they couldn't get that mortgage because they had medical collections. That's a different story now. So look back and see who you can really share that information with and make them a home buyer.
It's a great point.
Right. I think we're good. Thank you both so much. I think we all learned a lot today. And as I said, we'll be sending this recording out later today or early tomorrow. And Jeannie, if you wouldn't mind including your PowerPoint presentation, that would be great. John, is there anything you want to say in closing? Thank you again for sponsoring.
Absolutely. Oh, well, thank you very much. It's, my pleasure. And it's always great to do this because, I've always said that, we all have parts of the mortgage process to do. You as realtors have a portion of that. The mortgage guy has a portion of that. There's the credit side, the attorney side. There's so many facets to getting that mortgage. And that's why options are so important, and why credit score drives a lot of those options. And that's the one thing Jeannie said earlier about how things change. And in the credit world, things change consistently, and you got to be on top of that. And you need to have somebody that you could contact and make sure that they know what the changes are. Same thing in the mortgage side of the business. Mortgage side of the business changes all the time. I love when somebody says, well, somebody told me this, and I look at it, and that guideline changed like 8 months ago. So always consider, ask the question. Sometimes we get into a mode in our lives that we think, oh, I don't want to ask that question because it make me look foolish or whatever. There are no foolish questions when it comes to mortgages, credit, or anything like that, because the guidelines change so much that it's important for you and your clients to know what that information is. And like I said, with the crypto question, I don't know the answer right now, but I will get you the answer as soon as I can, and I will do that. So thank you very much for having us and having Jeannie and Mary, as always. So glad to be a part of Hagar and be a part of this whole process. And thank everybody for joining today.
Great, thank
Thank-
you all, and we will be putting John's and Jeannie's contact information in the email when I send out the recording. And I just wanted to remind you, our next Breakfast with Benefits will be on July 18th. We're going to be talking about mold and asbestos and dangers lurking in your home, so you don't want to miss that one too. But thank you all and have a wonderful day.
Thanks so much.
you.
Bye-bye.
Bye.
Bye, guys.